Click on the subscribe button and remember to press the bell icon for regular notifications from our digital blogger. Hello friends, welcome to our digital blogger. Today we're going to talk about LTCG or long-term capital gains. In this video we will talk about the definition of the very concept. At the same time we will see whether you should be affected by this particular tax, especially after the budget news. And we'll also be talking about specific examples of LTCG or long-term capital gains and how it's going to impact your investments, especially if you are a long-term investor who has been looking for high returns from their investments. Let's get started. So let's start with the basics. What is LTCG? LTCG stands for long-term capital gain. As the name suggests, whatever investments are generally made for long-term are going to be impacted by this particular concept of taxation. In this particular definition, it's basically the tax paid on the profit generated by an asset such as real estate, shares, or share-oriented products held for a particular time frame. Now this time frame is generally more than 1 year, and the definition of long-term capital gains is different for different kinds of products. Now in this video we'll be primarily talking about the stock market, how it's going to impact all your investments on that. Well, why is LTCG in the news these days? Now you might have heard that the budget has been released by our finance minister, Mr. Arun Jaitley. Now this particular minister in his union budget speech reintroduced the concept of LTCG, long-term capital gain tax on stocks. Now investor will have to pay a 10% tax on profit exceeding 1 lakh rupees made from the sale of shares or equity mutual fund schemes held for over 1 year. Till now, LTCG was exempted from tax. The definition of long-term investment in stocks for tax purposes is 1 year. LTCG tax on stocks was scrapped in 2004-2005 by then Finance Minister P. Chidambaram. Now that is the reason we are saying it has been reintroduced. It was not there for over a decade. Now the problem is in last 1 year, for people who have made long-term investments for especially for more than 1 year, they have seen profits in the range of 3,70,000 crore rupees, and there was no tax at all gained by the government of India. And this is where our finance minister sees an opportunity for taxation, and this is what he applies and says, we're gonna impact you, we're gonna have 10% on the profit exceeding 1 lakh of the profit you make. Now we will talk about specific scenarios later in the video, but just to give you an idea what exactly this means, this is where it is coming from. And there is a concept of grandfathering that is doing the rounds in the news these days. Now this has nothing to do with your grandfather or somebody else's grandfather. Now the grandfathering clause is the exemption granted to existing investors or gains made by them before the new tax law comes into picture. Whenever the government introduces a stricter tax law, it has to ensure that investors who have committed money, keeping in mind that the easier tax regime are protected. In the matter of LTCG tax on shares, the government says that the gains from shares or equity mutual funds made till 31st of January will be grandfathered or exempted. There will not be any LTCG tax on notional profit in shares till then. Well, that is a relief, right? Otherwise you might be seeing a lot of people just selling out their investments to save that extra 10% on their profits. Now this is clear. We know that you will not be taxed in case you have invested before this particular law came into picture, but what we need to know is who comes under LTCG. Well, the budget proposes that the LTCG tax will have to be paid on profit booked after March 31st starting this year. So the year, in this case, the profit you're booking on a yearly basis is absolutely based on the financial year and not the calendar year. Now this basically means that for sale of shares made till March, the existing law will apply and this tax will not be applicable. In short, if you sell before March 31st a stock that has been held for more than a year, you do not need to pay any tax. So for tax purposes, there should not be any motivation for investors to sell in February and March. However, if you sell it on or after March 1, or rather April 1, LTCG tax will apply on the gains made. Also, this tax is applicable only if LTCG, your long-term capital gain, is above 1 lakh in a financial year. So if an investor made long-term gains, let's say of 1.5 lakh rupees, cutting that one extra 1 lakh rupees, you are going to pay 10% of the 50,000 profit you made. So that's 5,000 as the LTCG tax you are going to pay for that profit booking. Simple, right? Now we need to know how to calculate LTCGs. We just saw one example, but there is a concept of acquisition price and closing price. Specific date of 31st January has been benchmarked for this. The higher price will be compared with the selling price, that is after 1st of April or on 1st of April, and the corresponding deductions will be made, and finally the tax will be calculated. Just to make this a pretty simple sort of an exercise, we'll do and check out some examples here. Let's start with example number 1 that says if you bought a stock before 31st of January, it could be 10 years before, 5 years, 5 days, 5 hours before 31st of January, the stock price was 1,000 rupees. On 31st January, the closing price of that stock was 2,000, and on 1st of April or any other day after 1st of April, when you choose to sell that particular set of shares, then the price is 2,500. Now the price between these two will be taken, the one which is higher, as a benchmark. So we can clearly see that 31st January price of 2,000 is higher. You are selling it at 2,500, so you are actually making a profit of 500 rupees on each share. And then let's assume that you bought, let's say, 1,000 shares. So overall, you had a profit of 5 lakh rupees. Remember, we're talking about only profit, not the overall revenue you're getting back from your trades. Now, 5 lakh is your profit. 1 lakh is exempted. So the overall tax LTCG you're gonna pay is 5 lakh minus 1 lakh, that is 4 lakh rupees. 10% of that, all right, which is 40,000 rupees. So out of this particular investment, 40,000 is going to be calculated as your LTCG. There will be a cess charge of 0.4% that you have to remember will also be deducted from your trades, and then correspondingly you can check out your profits from there. Then let's say if your price was 1,000 before 31st, on 31st the price went to as low as 500 rupees. You're losing money on this one, but when you reached 1st of April, when you're selling it at 1,500. The price in this case is going to be benchmarked at 1,000, the higher between the two, and 1,500 is what you are selling it at. Again, the profit you're making is 500 rupees. In 2,000, again the same case, 40,000 rupees is going to be your LTCG. Now these are the cases where you are actually paying money to the government as LTCG, but there are multiple other instances where you will not be. Well, let's see those examples. 2,000 rupees you bought before 31st. On 31st it was 1,000, so you can actually see that 2,000 is going to be the price that we are going to consider. Then you sold it at 2,000 only, no profit made, right? So at the same time you can understand that the LTCG is going to be 0 because there is no profit. Forget 1 lakh, there is no profit made on this particular trade. Then for example, 1,000 rupees on 31st, rather before 31st, 2,000 rupees on 31st. Then when you're selling it at 1,500 rupees, you're going to benchmark the highest price, 2,000. So obviously you might have bought it for 1,000, but the benchmark is going to be 2000 in this case. And although you're making a profit of 500, but since we are benchmarking 2000 here, you could have made a profit in this case since you did not sell it at this point in time. So you're going to be considering it as a loss again, and you are not going to pay any LTCG whatsoever. Then example number 5, you bought it at 2000 before 31st of January. On 31st it went as low as 1000, but you sold it at a mere 500 rupees. Another loss making situation. No LTCG on this case either. Last example in the trail, you bought it for 2000 rupees. The closing price on 31st of January was 2000 again, but you sold it for 1500. Another loss, and you are going to pay no LTCG at all. So you see, we took 6 examples. You can do all kinds of permutations and combinations by yourself, but as long as you are not making money on the price, but with the one which is higher between the closing price on 31st and the one you bought it at, you are not going to pay the money at all. So that's the more or less the overall calculation. So should I be worried, is the question you might be asking yourself. Well, you should be worried only on the instances we are gonna cross more than 1 lakh rupees, but even after that the overall tax is going to be 10%. Obviously 100% in your pocket always makes the best for you, but you're gonna have 90% from here on. Till this point in time, there was no tax whatsoever on long-term more than 1 year delivery trades. This is where this tax comes into picture. You book a profit of more than 1 lakh rupees, you're gonna pay some tax to that to the government of India. Well, that's it. In case you're looking to open a stock broker trading account or a demat account, you can get in touch with us. We can help you with that. Check out this link here, digitalblogger.com/free stockbroker suggestion. Put in your details and your preferences. We will set up a call back for you absolutely free. That's it for the video. Thank you so much for watching it. We hope you liked it. In case you did, please go and press the like button. We'll really appreciate that. You can follow us on different social media channels, as you can see on the screen: Facebook, Twitter, Tumblr, SlideShare, and of course YouTube with the same handle, Digital Blogger. Thank you so much again for watching this video. Bye bye.